73% of investment portfolios contain duplicate holdings. That means 3 out of 4 investors are paying fees on the same stocks twice, sometimes 3 times over, and most of them have no idea. Here's what that means for your money. If you're holding 8, 10, maybe 12 different funds right now, there's a good chance several of them own the exact same companies. Apple, Microsoft, Nvidia, Amazon. The same names sitting inside your large cap fund, your growth fund, your tech fund, and your total market fund. You think you're diversified. You're not. You're duplicated, and duplication has a real price tag. A portfolio spread across a dozen funds with an average expense ratio around 0.40% is quietly losing hundreds of dollars a year in fees before the market moves a single point. Cut that down to 3 funds at a blended cost near 0.05%, and the gap over 20 years is thousands of dollars that stay invested in compounding instead of vanishing into fund expenses. By the end of this video, you'll know exactly which 3 ETFs could replace that entire cluttered lineup, how the math reaches $900,000, and why owning fewer funds might be the smartest move you make this decade. The third one, the one most people leave out, is the piece that makes the whole system work. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now, if you're somewhere in your late 40s or early 50s, you've probably had that moment. You log into your brokerage, scroll through a list of funds you picked up over the years, and think, do I actually need all of these? Smart investors in their late 40s and 50s ask that question, and the answer, for most people, is no. Once you see why, you won't go back to the old way. So what should you actually look for in a retirement ETF? That's where most people start wrong. They pick tickers before they understand the filter. Let me fix that. The 3-part filter. Before I name a single fund, let me show you the filter. The specific tickers matter less than the principles behind them. Understand this filter, and you can evaluate any ETF for yourself, now and 10 years from now. 3 things separate a strong retirement ETF from a weak one. First, low cost. You want an expense ratio under 0.10% for your core holdings. That's the annual fee the fund charges just to manage your money. At 0.03%, you're paying $3 a year for every $10,000 invested. At 0.45%, you're paying $45. Same companies inside the fund, same returns, one just costs 15 times more to own. Second, quality screening. Does the fund filter for companies with strong balance sheets, consistent earnings, low debt, high return on equity? Not exciting metrics, but they're what separate companies that survive a downturn from companies that collapse in one. Third, growing income. Not just a dividend today, but a dividend that grows its payout every year. Here's why that matters. A fund yielding 3% that grows its payout by 10% a year will eventually pay you more than a fund yielding 7% that stays flat or gets cut. The growth is the engine. The starting yield is just the starting line. Low cost, quality screen, growing income. That's the whole filter. Now let me show you the 3 funds that pass all 3 and the specific role each one plays inside your portfolio. Growth, income, and the piece most people skip. Think of your retirement portfolio as having 3 jobs: growth, income, global protection. Each job gets 1 fund. 1, that's it. Job 1, growth. VU, the Vanguard S&P 500 ETF, one fund that holds roughly 500 of the biggest companies in America. The expense ratio is 0.03%, $3 a year on every $10,000 invested. VU has returned about 15% per year over the last decade, and roughly 15% per year since it launched in 2010. That's your growth engine, broad, cheap, and proven. Job 2, income. SCHD, the Schwab U.S. Dividend Equity ETF. SCHD holds about 100 companies, but it's selective. Every stock in the fund has paid dividends for at least 10 consecutive years. Then it filters for strong cash flow, low debt, and growing payouts. The expense ratio is 0.06%. The current yield is around 3.3%. And here's the part that sets SCHD apart. It's grown its dividend at roughly 10% a year over the last decade. That's 14 straight increases. Never a cut, not once. It's on pace for year 15. Let me do that math out loud. If SCHD pays you $1,000 this year, and that payout grows 10% annually, in 7 years you're collecting nearly $2,000 without investing another penny. That's not hope, that's a track record.
Now, I know some of you are thinking, what about bonds? Here's the myth. Bonds are the safe part of your portfolio. Here's the truth. Over the last 5 years, BND, the Vanguard Total Bond Market ETF, has delivered a total return that's essentially flat, slightly negative actually. Meanwhile, inflation is running at 3.4% as of July 2026. Bonds haven't protected your purchasing power. They've quietly fallen behind it. A growing 3% income stream that rises every year is doing more for your retirement than a fixed 2% that inflation eats alive. Job 3, global quality. This is the piece most people skip, and I'd argue it's a mistake. Right now, every dollar in VOO and SCHD is tied to one country, the United States. The U.S. market is extraordinary, but putting every dollar in a single economy is concentration, not diversification. The question is how to add international exposure without dragging your returns down. Most broad international funds are stuffed with low-quality companies from underperforming markets. You get the whole world, including the parts that weigh you down. The fix isn't to buy everything, it's to screen. IQLT, the iShares MSCI International Quality Factor ETF, holds large and mid-cap stocks from developed countries outside the U.S., but only the ones that pass a quality filter: high return on equity, stable earnings, low debt. The same principles behind SCHD applied globally. The expense ratio is 0.30%, higher than the first two, but you're paying for the filter that keeps the junk out. Morningstar gives it a silver rating, and the timing is worth noting. International developed stocks currently trade at about 15 times forward earnings. The S&P 500 trades near 20 times. That's roughly a 25% discount. Quality international companies are priced well below their U.S. counterparts right now. Here's how these three stack up side by side. VOO gives you the engine. SCHD gives you the income. IQLT gives you the global hedge. 3 funds, 3 jobs, no overlap. Quick question before we keep going. How many funds are sitting in your portfolio right now? Under 5? Over 10? Drop your number in the comments. I read every single one. Your path to $900,000. Now let me show you the allocation and then the math. If you're around 50 years old, a clean starting split is 55% in VOO for growth, 30% in SCHD for income, and 15% in IQLT for global quality. Closer to 45, push a bit more into growth, 60, 25, 15. Closer to 55, shift toward income, 50, 35, 15. 3 funds, 1 annual rebalance. That's the system. Now, before I show you the numbers, take a guess. If you're 50 years old, you have $220,000 saved, and you invest $1,000 a month from here, how many years until you reach $900,000? Hold that number in your head. At a blended return of 8.5% per year, here's what happens. By age 55, after 5 years, your portfolio is around $430,000. By age 60, after 10 years, you're looking at roughly $720,000. And by age 66, 16 years from now, you cross $900,000. Let me think through that. $220,000 starting, plus $1,000 a month, that's about $33 a day, compounding at 8.5% over 16 years. Your total contributions are about $412,000. The rest, close to $500,000, is growth. That's what time in the market does when you're not bleeding fees across a dozen overlapping funds. Now, here's the number that caught me off guard. Actually, let me rephrase that. It's the number I wish someone had shown me at 45. If you wait 5 years and start at 55 instead of 50, you'd need roughly $1,800 a month to reach the same target by 66. Nearly double the monthly cost. Same 3 ETFs, same system, but 5 fewer years of compounding changes the entire equation. And once you reach $900,000 at a blended yield across all three funds, your portfolio generates roughly $1,200 to $1,400 a month in dividends without selling a single share. And because SCHD's payout grows every year, that income keeps rising even after you stop contributing.
So now you know the math, but knowing and doing are different things. If someone you know has a messy portfolio full of funds they forgot they owned, they need to hear this next part. Share this video with them now. It could save them years of drag. Let me give you the exact steps. What to do this week. Step 1. Open a low-cost brokerage account if you don't already have one. Fidelity, Schwab, or Vanguard. All three charge 0 commissions on ETF trades. All three work. Step 2. Set up automatic monthly investments into your 3 ETF split. 55% VOO, 30% SCHD, 15% IQLT. Automate it so the money moves on the same day every month before you have a chance to second-guess the market. You cannot panic sell what you never touch. Step 3. Rebalance once a year. Pick a date. Your birthday, January 1st, whatever you'll actually remember. If any fund has drifted more than 5 percentage points from its target, sell the overweight and buy the underweight. That's it. No daily checking, no chasing headlines, no tweaking every time the market dips. Here's why that discipline matters more than stock selection. The Dalbar 2026 study found that in 2024, the average equity investor earned 16.5%, while the S&P 500 returned 25%. That's an 8.5-point gap, not because the market failed those investors, but because they bought and sold at the wrong times. The single best thing you can do for your portfolio is take yourself out of the daily decisions. Automate, rebalance once a year, and let the system do its job. 3 funds, 1 rebalance a year. No overlap, no guesswork. Fewer funds, lower fees, and the patience to let them compound. That's the whole system. Tell me in the comments, are you going to simplify your portfolio? What's your number going to look like? I want to hear it. If you're building a portfolio designed for retirement income, subscribe to Golden Goals. I break down what actually protects and grows your money with real numbers every single week.